You tap your phone against a coffee shop reader, and in seconds, your morning latte is paid for. But this simple gesture represents a 15-fold expansion in 12 years of how money moves around the world. Digital wallets, real-time rails, QR codes, and buy now pay later platforms now form an interconnected ecosystem that touches billions of users worldwide. Yet this revolution happened through 5 distinct leaps that each solve problems the previous form of money couldn't handle. Before money existed, humans relied on barter, a system where you traded what you had for what you needed. Picture this: you're a chicken farmer who needs new shoes. You'd have to find a cobbler who not only makes shoes, but also wants chickens. This requirement, that both parties must need exactly what the other offers at the same time and place, became known as the double coincidence of wants. The math was brutal. As goods and services diversified, finding matching needs became exponentially harder. Your chickens might be perfect for the cobbler, but if he already had enough poultry and needed grain, instead no trade happened. You'd walk away empty-handed, forced to search for someone else in an endless chain of mismatched needs that could take weeks to resolve, if it ever did. Barter worked for small homogeneous communities, but it collapsed under the weight of complexity. Money solved this by becoming a universal medium both parties would always accept. Coins emerged as the solution. Around 650 BCE, the Kingdom of Lydia struck the world's first coins from electrum, a naturally occurring mixture of gold and silver. Now you could trade your chickens for coins, then use those coins to buy shoes from any cobbler anywhere, anytime. The double coincidence problem dissolved. The idea spread rapidly across Greek cities and the Mediterranean, but coins created their own obstacles. Clipping became rampant, as people shaved precious metal from edges, and transporting large amounts required carts and armed guards. A house-sized purchase meant hauling thousands of copper coins. This weight problem drove Chinese merchants in the 7th century to invent paper money. Bills solved what coins couldn't: portability without sacrificing value. So after covering the double coincidence problem with barter and how coins solved that, but created weight issues which paper money then fixed, which form of money do you think had the biggest impact on your daily life? Coins for creating universal acceptance, or paper bills for making large transactions portable? Drop your answer in the comments below. Now let's see how paper money itself hit a wall. Paper money hit its own wall when commerce went global. You couldn't mail gold-backed bills across an ocean without massive risk. Carrying cash for expensive purchases meant walking around with a fortune in your pocket. Credit systems emerged as the breakthrough. Instead of needing physical money in hand, you could promise future payment backed by your reputation and resources. This freed commerce from the constraints of physical transport, enabling transactions that coins and bills simply couldn't handle. But this liberation came with new complexities. Every transaction creates a digital trail tracking your spending patterns. The system relies on debt. You're borrowing money you don't yet have, creating interest obligations that compound if unpaid. The convenience of spending money you don't physically possess opened global commerce. But it also opened the door to debt spirals and privacy erosion that cash transactions never created. Digital payments emerged as the solution to credit's biggest weakness: speed and accessibility. Hundreds of millions of Americans now use digital banking services, while billions of people worldwide access online banking. What took days or weeks with credit cards now happens instantly through QR code-based mobile payments and contactless systems that made transactions as simple as tapping your phone. Mobile payments have reached massive global volumes driven by this shift toward instant settlement. This transformation solved credit's friction problem by making money move at the speed of data rather than the speed of mail, eliminating the waiting periods that plagued credit transactions. But this speed came with a new dependency: complete reliance on technology infrastructure that didn't exist when your grandmother needed to buy groceries. Significant portions of Americans now own cryptocurrencies, with global crypto adoption growing rapidly. While most countries representing the vast majority of global GDP are exploring central bank digital currencies, with dozens of countries in advanced development phases, these aren't just new payment methods, they're competing visions for money's future that solve problems digital payments created but couldn't fix themselves. Stablecoins are becoming the internet's dollar, offering the stability of traditional currency with the speed of digital transactions. While China's digital yuan has processed billions of transactions worth trillions of dollars. Meanwhile, the United States has taken a different approach, choosing instead to let private innovation lead. That coffee purchase you made this morning, the one that took seconds with a phone tap, now exists inside a monetary ecosystem where your transaction could settle on a blockchain, be recorded by a central bank, or flow through a stablecoin network. Money has stopped being a thing you hold and become a protocol you participate in. We're not waiting for the future of money, we're living it. This evolution from barter to digital protocols isn't just historical curiosity, It's reshaping how you should think about your financial decisions right now. Each leap we've covered created winners and losers among those who adapted early versus those who waited. The shift to coins favored merchants who understood weight advantages. Paper money benefited those who grasped portability before others. Credit systems rewarded people who built strong borrowing relationships. Digital payments gave advantages to tech-savvy users who embraced mobile banking early. Now, as we stand at the threshold of programmable money and central bank digital currencies, the same pattern emerges. Early understanding creates opportunity, while late adoption means playing catch-up. Whether you're choosing between payment apps, considering cryptocurrency investments, or simply deciding how much cash to keep on hand, you're making bets on which direction money moves next. The question isn't whether money will keep evolving, it's whether you'll recognize the next leap before it becomes obvious to everyone else. Subscribe for more on how money keeps evolving, and watch our deep dive into cryptocurrency and blockchain next.